So I have an important warning for all investors in the stock market right now. Please listen up. This is super important. Don't click nothing. Don't smash nothing. Don't buy nothing. I ain't selling Deadly Squad. Just listen to me. The information is super important. Now, like in every one of my videos, the bottom line is going to come first, and then you can head out. But if you want to stay for the full analysis, you're more than welcome to do so. So listen to me carefully here. A month ago, when Nvidia was trading at $130, and then all of a sudden it dropped to $98. A lot of people were panicking, running for the hills. But smart, experienced investors, like the ones we have in my community, basically knew exactly what was going on. And we knew how this thing is going to play out. There was a limited time to get the stock at a cheaper price. And lo and behold, the stock is now back at $130 a month later. So if you like Nvidia as a stock, and you didn't buy at 98, you didn't decrease your cost basis in the stock, and you set out because you feared that it might drop further, well, that's a good lesson for you, and that really is applicable to what is kind of brewing up in the market right now, which I want you to be prepared for. You see, the S&P 500 is currently at 5,600, very, very close to the all-time highs. By the time this video comes out, maybe we pass it, maybe we go lower, but we're flirting with all-time highs again. And we're up 4.3% over the past 5 days. We're up almost 20% year to date. So the index is doing very well. The problem with an index that's doing very, very well is that we have a lot of stocks right now in the stock market that are beginning to be a little bit overextended too quickly. The problem isn't that the price is going up. The problem is that the price is going up a little bit too quick. And when you steer away and you get away from the average too quick, the inevitable result is always going to be a correction. Much like with sports, if I'm Steph Curry and I'm shooting 40% from three-point range, and after 60 games, I'm at 55%, what's going to happen? Well, my percentage is going to drop all the way back to 40 in the remaining 25 games, 26 games, whatever that may be. And the same principle applies in the stock market. If the average is getting left behind by the index and by individual stocks that are flying way too quickly, way too high, eventually the correction is going to bring it back down to earth. That's how this thing works. Now, what am I saying here? I'm saying here is that the market in its current configuration is a little bit overextended and is due for a correction. Maybe a small correction, maybe a small pullback, maybe a major correction, maybe a serious pullback, and maybe nothing. But to sit here as a smart investor and to ignore what seems to be brewing up in this market just because I'm a bull, and make no mistakes about it, I'm an uber bull on this market for the next 3, 4, 5 years. To sit here and absolutely ignore the fact that we're currently in a setup for a correction short term is going to be performing a disservice to my community, and I'm not going to do that. So as a service to my community, I'm going to show you the data. And I'm going to show you what I'm thinking and how I'm prepping for this. Because a lot of you may say, well, Tom, just a few days ago, you told us that this is 1995. And because this is 1995, the next 4 years are going to be epic explosion of gains. Well, the market doesn't work like this, my guy. It doesn't. The market goes up, it goes down. It does not go up in a straight line for 4 years. You're always going to have corrections. And if you're seeing one coming a mile away, just sit there and ignore it and say, la, 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 this is not happening. It's not a good strategy for a long-term investor. Having said that, I see a correction in order for this market. Whether it happens this week, next week, or doesn't happen at all, I do not know. But what I will do, I'm going to set up everything so I'm prepared if it actually happens. Now, the first principle I want you to understand is that no matter how deep this correction is, no matter how scary or alarming it may be, I will not be selling any stock or any shares or anything of that sort during this correction. None whatsoever. What I will offer to you as a potential strategy for a long-term investor is one of two things. One, which I will be doing, is use this crisis to leverage yourself into a better cost basis. What do I mean? Do you take leverage? Do you borrow money? No, that's not what I said. By leveraging yourself, what I mean is that if a correction happens and actually takes prices of stocks that I want to own, in my case, Tesla or Palantir or the S&P 500, and it drops these prices below a certain threshold, then I will be buying more of them on an ongoing basis. And I'm not going to stop until the price climbs back up. But if a correction doesn't happen, Well, I'll just keep buying normally every single week like nothing happened. But there's another thing you can do here. I'm not a huge fan of it myself, but it's a legitimate strategy for long-term investors. If you're seeing a correction ahead and you want to buy some insurance, what you can do is set up some stop losses. If you have a lot of stocks in which you have a lot of gains and you feel like the market is getting a little bit overextended, this would be a good time to put in some stop losses that if the feet hit the shan, so to speak, then in that case, you're not going to be absolutely demolished by whatever happens. And psychologically, mentally, you're going to be in a better position because seeing red in your portfolio is not for everyone. Now, I'll tell you what. In my view, the most important part of this preparation project that I'm doing here in this video is not the numbers, it's not the mathematics, which I'll show you in a second. I'll show all the data and what am I basing my theory on and everything so you can judge for yourself, because what I want to develop here is a community of thinking people, not for robots that do what I think is the right thing, right? But beyond that, I think 80% of what we do here and 80% of investing in general is all mental and emotional. So if you want to prepare for an upcoming correction or a pullback or even harder than this, what you need to do is basically mostly focus on your psyche and your emotions. Make sure that you understand that this is coming, and when it's coming, you have a plan. And that plan is do ABC. Don't improvise. Don't do anything outside the plan, and just carry out whatever the plan you set up when you were thinking logically and not emotionally. Doing that is 80% of the business. Now, let's talk a little bit more in depth about what's coming up. Now, year to date, the S&P 500 is up almost 20%. NASDAQ is almost up 20%. These are terrific numbers, but way above the normal performance of either of these indices in a normal year, right? Let's continue. The S&P 500 is slowly getting into overbought territory. What do I mean by that? Well, about 50% of the stocks in the index, in the S&P 500, is currently overbought. On top of it, we have moved a long ways away from the 200-day moving average. Right now, the 200-day is at 5,000. We're currently at 5,600. So we're getting ahead of the average. And when this happens faster than normal and more aggressive than normal, well, the average serves like a magnet. It's going to pull the market back down so it continues to rise slower. Whether this happens today, tomorrow, next week, or doesn't happen at all, I don't know. But looking at the current setup of the market, here's what I'm seeing. We've started the month of August on the S&P 500 at 54.46. That was the 1st of August. Currently, after all the turmoil, the turbulence, and all the volatility, we're at 56.08, at least as of the making of this video, right? So we're up 3% on the S&P 500 in August so far, in the first 20 days of the month. Now, that's good, right? Well, yes and no, and I'll explain why I'm saying no. You see, there's a statistic that shows what happened in the 23 times that the S&P 500 started the year with above 10% performance. This year, with 11.4%, so we are in that category. A really, really good first half, above 10%. Whenever that happens, the average performance on the August month is negative 0.6%. So if we're talking again about averages, right? The average here shows us that August is supposed to be a negative 0.6% month on average. And we're currently running at 3%, a lot higher than the average performance of August in a year like the year we're having right now. Does it guarantee that we will have a correction? No. Does it guarantee anything? No. Past performance statistics, they don't guarantee any individual results in any specific years. There's always outliers. But the general concept is that we are above, almost 4% above the average where we should be in August in a year like today. And when you add it up to an overextended market and overbought S&P 500 and the fact that we have Friday coming up in Jackson Hole, this smells to me like correction territory. Because what happens in Jackson Hole when Jerome Powell is going to give his speech on Friday is going to determine whether this correction actually happens or not. And I'm going to explain right now what. Because whatever Jerome Powell does in Jackson Hole on Friday is going to determine a big piece of what happens in the next couple of weeks. I'll explain. Because you see, last year, Jackson Hole with the dovish Jerome Powell gave us plus 4% on the S&P 500. That's good. But a year prior, when Jerome Powell was talking about more pain ahead, the market ended up tanking 8% on the day. So whatever Jerome Powell says in the Jackson Hole speech is going to have a huge impact on that market. Because you see, people will be focusing on two things that Jerome Powell is going to have to answer. Number one, are we getting a 0.25 or 0.5? That's number one. Number two, is it a one and done? Or are we willing to talk about more cuts this year? 2, 3, 4, 5 rate cuts is going to be very important to what the market does with it as far as a potential correction, yes or no. But you have to consider the fact that Jerome Powell might say something which the mainstream media is going to take and make shish kebabs from. It's going to drop the market. It might happen. Now, as a smart investor, all you got to do is prepare for every scenario, every alternative. You got to be prepped for if the market goes up or the market goes down following what happens on Friday in Jackson Hole. You have to have a game plan. If the market keeps going up, your dollar cost average in a normal pace. If the market drops and your stocks are getting to a zone where you would like to increase your dollar cost average, increase your annual buying, weekly buying, monthly buying, whatever that is for you, increase the continuous buying you have of these stocks, then the drop is your friend. Because long term, I remain very bullish on this market. Very bullish. Because here's the thing. Look at the data with an objective analysis, right? Gross domestic product is up. It's up above expectation. CPI is down a lot faster than people thought at 2.9%. We have consumer spending doubled than expected. Inflation is below 4.5%, is actually doing better than people expected with the claims. And we have oil below $80 per barrel in August, which is supposed to be the peak month for oil. We have the Middle East situation easing up. People are talking about a ceasefire. So World War III, at least for now, is kind of off the table. We have easing monetary policy by the central bank in the United States. So we have a Fed that's going into a cutting cycle for the next year. We have massive M&A activity starting to happen, which we haven't seen in years. We have obviously AMD spending $5 billion all over the news. You saw it. We have Mars buying up Kellanova, essentially Snickers buying up Pringles for $36 billion. And we have a Canadian company trying to buy 7-Eleven for $30 billion. All of this is happening right now. And all of this is happening because cheap money is about to hit the market. So M&A activity is back on the table. It's a clear indication of a revamped market. The next thing is IPO activity, but that's, again, down the pipeline. But here's the thing. Since 1950, whenever we had a first half of the year of 10% or more, which we had this year in 2024, 83% of the times the second half was positive, and the average return in the second half of the year was 10%. And since 1928, the bottom of the second half was August 50% of the time. So August, statistically, is really the Schitt's Creek of the second half of the year in a setup like we have right now. Especially if you look at S&P 500 earnings. 81% of companies beat earnings with an average of 5% in this season, with about 90% of companies that have already reported. So the setup is not bad at all. So what do you do in the setup except DCA? Well, Tom, you've been banging the drum about DCA this and DCA that, and DCA normally if it goes up, DCA faster if it goes down, but what else? Well, there's actually a lot of opportunities in the market even as we speak today. Yes, NVIDIA corrected. Yes, Palantir corrected back, but there's still a lot of opportunities. One is what Tom Lee has been saying for weeks, for months. Hey, look at the IWM, look at the Russell 2000, look at the small caps. These guys haven't had an all-time high in 700 days in 2 years. They've completely missed the 2023 rally, and they're down from November 2021, minus 12%. And all of this happens because the Fed raised interest rates. Guess what happens when the Fed starts cutting rates? It's going to be the opposite. Tom Lee is saying it, not me. The opposite process is about to happen. And the funny thing about it is, despite the market being very good at pricing in present times future developments, somehow the IWM is still lagging. Since Black Monday on August 5th, it's up 5%. The FANG is up 10%, so half the FANG. So Tom Lee isn't wrong here. It might take time and it might find new bottoms before it spikes up again. I don't know. But as a general concept, if you're looking for untapped potential, the Russell 2000 is in a really good setup if the Fed actually drops rates and if the economy doesn't collapse. To this point, it seems the economy ain't collapsing and Fed is dropping. So that's a really interesting space to actually explore opportunities in. Now, I want you to understand something. Despite the choppiness ahead, despite the volatility ahead, despite the potential deep stock market correction that might happen. Who knows? The rest of 2024, after that plays out, seems to be in a great setup for a bull run. Now, I remain bullish, which means I'm going to be doing the following. I'm going to be using the sideways period we have in August, potentially if it continues into September, which statistically it should. I'm going to use the next month and a half to acquire cheaper stocks. And then if the market goes into hyperdrive in October, November, December, then I'm going to slow back down and DCA is normal. That's the only thing I'm going to do. Warren Buffett literally tells you, hey, when everybody's bullish, you got to be bearish. And when everybody's bearish, you got to be bullish. That's all. And we've been doing it. We've been doing it in 2020, 2021, 2022, 2023. This year, the Monday mayhem that happened, we bought. So pay attention. Keep your head in the game. Join our community at Discord, discord.gg/tomnesh. Surround yourself with smart, level-headed people that's going to keep you in check. And obviously, as you can see, since I'm home, the Academy is going to reopen once this video launches. We're going to reopen another 10 spots for new members. We have a lot more planned for this month, next month. We're going to do some incredible things in the Academy. Would love to see you there. Thank you so much. I'll see you next one.